I couldn't believe that you could actually do this stuff. It was legal.
Wow, why don't more people talk about this?
I have a master's in taxation, and I never heard of this self-directed IRA.
So hello, everyone. Welcome once again. This is Steve Taylor. I am the host of the Do It For Yourself podcast, where every few weeks or over a period of time, we try to bring guests on. We try to have conversations about things that you're going through actually in your business, right? That might be helpful and come up with. And then certain times we'd like to bring subject matter experts to talk about items that really may pertain to you that you may want to think about, whether personally or in your business. And so today's conversation is really going to be that latter. And this is a topic that I've known about for a good period of time, but it's kind of one of those things that comes up. People kind of hear about it. They hear about it with a lot of misinformation on it, but it is just a great strategy, a great technique where you can use it. And hopefully, I know our guest today is going to really shine a lot of light on this for you to say, when to use this, how to use this, and what this is. But without further ado, Adam, please give us a little introduction and a little bit about your business.
Okay. Well, thanks so much, Stephen, for having me. Really appreciate it. Really excited. So I used to be a tax lawyer, and I worked in New York at large law firms as a tax associate. And I never, ever knew that you could use your retirement funds to invest in non-traditional assets, right? In real estate or other stuff. So my story is pretty interesting. I was an 8th year associate at a big law firm in New York. And I had a client who was a big partner at a hedge fund, Connecticut, and he wanted to use his IRA to invest in his hedge fund. And I got tasked with the assignment. The partner I was working with said, "Hey, Adam, why don't you research this?" And I was blown away. I couldn't believe that you could actually do this stuff. It was legal. I always thought that, hey, you had to buy stocks and mutual funds or ETFs with your retirement money. And I was just really enlightened by this whole IRA, self-directed IRA world. And it got me thinking that, hey, if I'm, a pretty educated guy, tax lawyer, I have a master's in taxation, and I never heard of this self-directed IRA, there must be millions and millions and millions of Americans out there that would want to do this with the right help and expertise and would want to learn about it. So I literally quit law and I started IRA Financial about 15 years ago. And now we got about 26,000 clients, over 4 billion in assets. And we just want to help people unlock their retirement funds and invest in assets they know and trust.
That's awesome, Adam. Yeah, it really is something. I think my background isn't that different from yours. When we start finding out about this and this opportunity, it gets you excited, right? It gets you excited, something different. Wow, why don't more people talk about this? And so to give a little context for the listener out there, I think one of the highest profile cases, regarding this and doing this kind of strategy was Peter Thiel. I think it was either his Google or maybe one of his PayPal shares, right? He put a big, when they went and they invested in, I think it was either PayPal or Google. They transferred those shares into there, and those, we know that story, and got a tremendous amount of money into the IRA. So it just gives people some context out there about what this is. So let's start real quick, Adam. Just really, take it very, very 101 for someone that, has never heard about this. Talk a little bit about what this strategy is.
Okay, so when IRAs were created in 1974 by ERISA, the tax code did not distinguish between an IRA that bought stocks and an IRA that bought real estate. Okay, so the tax code only states 3 things you cannot do with an IRA. That's it. And that's found in section 408 and 4975 of the code. And here they are. Can't buy collectibles like art. You cannot buy life insurance, although you could in a 401k. And then the third and broadest category is found under 4975. And it says, in sum, you can't do anything with your IRA that in any way directly or indirectly personally benefits you, your lineal descendants, your parents, your children, your spouse, daughter-in-law, son-in-law, or any entities controlled 50% or more by such persons. So, for example, you can't buy a house and live in it with your IRA. You can't take your family to Disney with your IRA. You can't buy yourself a car. Everything you do with your IRA needs to 100% exclusively benefit your IRA. So you buy Tesla stock and it goes up and you sell it, all the money goes back to your IRA. You buy a piece of real estate, you sell it, or the rental income, all goes back to your IRA.
Yeah, so that's really, what it is, that getting in there. And I think while we talk about where I brought up, some private company shares, I have a lot of clients that have really done that strategy in it. I think, as you mentioned at the beginning, a lot of people, what they like to do with these IRAs is buy actual real estate, right? Buy actual real estate that they might, an investment property. Now, once again, like you say, they can't personally benefit from it. So for someone, that has an IRA, has some funds in it, kind of walk us through how that kind of looks like, that if they're thinking, hey, this might be a good idea for me. I want to diversify. I have a good amount of my IRA. I want to buy real estate. Kind of, how do they go about doing this to make sure that they, do this right, and how does it work?
Yeah, it's actually fairly simple. You can do it for less than $500 a year. You basically can go to a company like IRA Financial, and you can open an account. Within a day, you just fill in some basic info like you would at Schwab. Your personal info, social, and you move the money tax free right from wherever the money sits now, whether it's Fidelity, Schwab, Vanguard, Merrill. And then once the money hits your self-directed account, then you decide where you want to invest it, and we literally will wire the money to wherever it goes. And the beauty, and this is something I should have double clicked on before, Steve, is that, hey, the big advantage of using an IRA is not just diversification, but it's tax benefits, right? When you buy and sell something in your IRA, there's no tax. So you don't have to worry about holding periods. You don't have to worry about ordinary income tax, short-term capital gains, long-term capital gains. In general, it's all tax-free, right? So here, Peter Thiel, who's actually my idol. So this is what Peter Thiel did. He actually used a mentor of mine in 1999. Roths were created in 1997, and a Roth IRA is an after-tax IRA. So unlike a pre-tax IRA, where you get a tax deduction for the money you put in it, and you pay tax when you pull it out after 59 and a half, a Roth IRA, you do not get a tax deduction when you make the contribution. But so long as you're over 59 and a half and the Roth's been open at least 5 years, everything's tax-free. So this is what Peter Thiel did. He and Elon Musk and a bunch of other guys started PayPal. And remember, he owned less than 50%, right? Because if he owned more than 50%, he would not have been able to do it under the 4975 prohibited transaction rules. So that was good. Second good thing is he paid fair value, right? Because it was a startup. So he literally paid par value per stock, which was like 0.00001. So he actually spent about $1,800 on a bunch of stock in PayPal. And within several years, he sold it for around $26 million, tax-free, right? And then what he did the next thing, he's a smart guy. He was the first investor into Facebook. He put 500 grand into Facebook, and he turned that into almost $400 million tax-free, right? So now people estimate that he has close to $5 billion in a Roth IRA. He's under 59 and a half. He's, I think, around 57, 58. So he's got to wait a couple more years to get some good liquidity. But once he does, he's going to have tax-free wealth, pretty enormous wealth.
Yeah, he's done an amazing job there. So let me go back to the real estate, because one of the things that comes up, and you could speak to, most people, when they go and they buy a piece of real estate, right? Many of them finance that real estate, right? They get a loan on it.
Yeah.
Can you talk to, I believe you can do this in the IRA, but it's more complicated, that if you don't have enough funds in that IRA to buy that piece of property outright, are you able to take a loan, and kind of how complicated is that?
Yeah, great question. So in most cases, as I mentioned, whether you're generating capital gains, interest, dividends, royalties, rental income, all the income and gains in an IRA will be tax-free. However, there's something called unrelated business income tax, or UBIT, which unfortunately gets triggered in an IRA when you use leverage to buy real estate, or when you use leverage like margin to buy stocks. So there's two things you got to keep in mind if you're using and thinking about using leverage alone to buy real estate, right? For example, you have 100K in your IRA, you need to borrow 100K to buy the $200,000 piece of property. So you can always go to friends and family, but if you can't do a joint venture with anyone and you can't find anyone, you go to a third party lender. And number one, the loan has to be non-recourse. And what does that mean? You cannot personally guarantee the loan. Why? Because Internal Revenue Code section 4975 does not allow you to personally guarantee an obligation of your IRA, just the law. And then once you can get a non-recourse loan, which you're going to pay a little bit of a premium on that because the lender's taking greater risk. So you're generally going to have to put down probably around 30 to 40% down, and you're going to be paying point to 2 points higher probably on the interest. So that's an obstacle. And then the second thing is this UBIT tax. And this UBIT tax basically gets triggered because the IRS was basically penalizing people to use leverage. Why? Because it goes back to how charities are taxed under Section 512, and IRAs, like charities, are tax exempt. So unfortunately, it falls in these complicated rules. But here's how it works. If you borrow 100K and you have 100K in cash, so your debt to equity ratio is 50-50, right? So basically the way the UBIT works is if you have more than $1,000 of net income from the property, right? Let's say after depreciation, after expenses, there is a tax on that net amount above $1,000, and the highest tax rate is around 37%. So it's a pretty big tax, and it gets triggered at a very low rate, around $15,000 or so. So it is a tax that you have to be in mind. There are ways to minimize it. For example, you can use a blocker, a C corporation, that can block the UBIT tax and bring it from 37 to 21%. The other thing is you can use losses. So in a lot of the initial years, as real estate investors know, there are losses from depreciation and the like. Those could be used to offset future gains and reduce taxation. Or you can use a 401k. So if you're self-employed, you're a real estate person, you can do a solo 401k, which is kind of like an IRA. You can still self-direct it, but there's an exemption from UBIT under Section 514C9 that lets you use a non-recourse loan to buy real estate and not pay this ugly 4-letter UBIT tax.
Okay, that's only for the 401ks.
Unfortunately, yeah. The IRA, you kind of minimize it or like restructure the deal.
So let me ask about that. Do you guys, because that's in our practice, we get a lot of people with solo 401ks, and I like to tell clients, it kind of looks like an IRA, right? But you get some other good benefits. Maybe you could borrow against it. You can hire contribution limits. Does your firm, do you guys work with the 401ks as well, or just the IRAs? Because I've seen different promoters come to clients and really talk about and promote, hey, buy your next business out of your 401k.
Yeah, we do both. I've written 9 books, but I've written a bunch on solo 401ks. Yeah, we have thousands of clients that use our solo K. And the beauty of our solo K, it's open architecture, right? So you can open a brokerage account, right, at Vanguard or Fidelity and buy stocks, and you can also self-direct and buy real estate or do different stuff. And yes, as you mentioned correctly, you can borrow $50,000 or 50% of your account value, whatever's less. Use it for any purpose, the loan, finance a business, pay for college for your kids, whatever you wish, and you're paying yourself back instead of a third-party lender. So that's good. You could put away a lot of money, $70,000 or $77,500 if you're over 50 in 2025. In fact, you can still set one up for 24 as long as you haven't filed your final tax return. There's also now a special catch-up if you're between age 60 and 63. You can go to over $82,000. So there are really exciting opportunities with the 401k, but for a real estate investor, you get that cherry on the top where you can also use leverage and not pay this UBIT tax. So that's a really nice strategy for a lot of real estate investors.
Yeah, that's really great to learn. That's worth the price of admission here, Adam. Thanks for that. I did not know that. But let me touch again now about the strategy. Like I said, that had come up before. I saw someone talking about it, about this idea of taking your 401k and purchasing into a business, right, that you're going to do with it. Now, it seemed like when you went back to before that third prong, right, is that everything needed to, once again, this might have gone for the IRA, need to only benefit the IRA, it couldn't benefit you and your family. But is there this ability in the 401ks to use those funds to actually buy a business which you or someone you're related to may actually be involved in?
Yeah, you're a lawyer. You know how it is. There's always workarounds. So
right.
So this is the workaround. So 4975C are all the prohibited transactions, right? Basically, in sum, as I mentioned, you can't personally benefit from your investment, right? And you would think, okay, 4975C clearly says you can invest in a business you control 50% or more. So what are you talking about? Well, 4975D as in David are all the exceptions to 4975C. And the big exception under D1 is the loan, right? The 401k loan we just talked about. There's also another really interesting exception under D13 that allows a 401k to buy qualified employer securities, which is corporate stock. And this was probably put in the tax code. Really, the intent was probably to let people that worked at like Ford or IBM or GE to use their 401k to buy stock in their adopting employer, the company they work for. but it's been stretched. The rules have been stretched to apply to startups, right? Not publicly traded companies, just a restaurant or a store, whatever the case may be. But the two elements you need is you need a 401k, cannot be an IRA, and you need a C corp, can't use an LLC, because you need to actually affect the purchase of qualified employer securities, which is when the 401k buys the corporate stock. So that is the workaround where, yes, you can actually use your pre-tax retirement money to fund a business and own more than 50%, get a salary out of it, because once you satisfy D, 4975D exception, the prohibited transaction rules under C do not apply anymore. So then you're basically operating a regular old for-profit business.
Interesting. Do you see that a lot? Do you see a lot of people doing that? Because most of the conversations I have, it's in regards to real estate and not necessarily these operating businesses.
Yeah, we do. We've probably done 1,000 plus over the years. It's not as popular just because a lot of folks just don't know about it, right? There's not a lot of companies that do it. We're one of the few. There's probably less than 5 in the whole country that do them. So Jen, I would agree with you. I think it's definitely more common to just do real estate. There's millions of Americans doing that. But the business, it's called a ROBS, a rollover business startup. That's the acronym that's used to identify a transaction where the 401k invests into the corporation. They're getting more popular, but it's just not well known.
Okay. And so, going back to where we started, we're talking about Peter Thiel, when that came out and got to be known, obviously many people were in uproar, right? There's the cave people, I like to call them, right? Citizens against virtually everything, right? And they're saying, oh, we have to curb this.
Yeah.
This has to be stopped. And we can't do this anymore. Are you seeing anything? Is there any proposed legislation, any proposed IRS, revenue codes or rulings or anything in there to try to curb or change the use of these strategies?
So, without getting political, there was something in 2021 with the Build Back Better when President Biden, came into office. He tried to push all this very aggressive legislation, and it all got kicked aside. But there was a few provisions in there trying to cap, for example, Roth IRAs at $10 million and try to limit some alternative asset investments. That was mostly pushed by Elizabeth Warren and Senator Wyden of Oregon, who are generally against wealthy people, but it got kicked aside very quickly.
Okay.
It never made it. Yeah. So is it possible in the next 20, 30 years that we can see some limitations? Maybe, but honestly, there's less. The statistics came out. There's less than a few thousand people that have more than 10 million bucks in a Roth IRA. So what problems are you solving? It's not going to create more tax revenue because they're after tax accounts anyways. So you're really penalizing people that are just savvy investors.
Yeah. Yeah. No, it's interesting you're saying, you've really recited so many of the retirement plan rules out there. And so for people out there listening and they hear Roth IRA, and lots of times when we talk to people, we talk about Roth 401k, they basically work the same way, right? And it's after tax money and the money grows tax free. But what's nice about the Roth 401k is that you can get a lot more money in there quicker, right? If you're looking at a Roth IRA, it takes forever to get any meaningful money in there, right? But if you're on the contributions, the Roth 401k strategy is a great one to have in there. I do that with clients that, hey, listen, build up that Roth so you have more money for that next investment that's out there.
Yeah, let me double click on that. So like a Roth IRA, you can only put in 7,000 or 8,000 if you're over 50. If you have a solo K, just on the employee deferral side, you can do 23.5 in Roth, or if you're over 50, you can do 31,000 in Roth. But here's the thing: there's something called a mega backdoor Roth 401k that actually lets you go all the way up to $70,000 in Roth, dollar for dollar. So if you made, let's say, $75,000, $80,000, and it's a side gig, you don't really need the money, you just want to save it, you can literally put $70,000 away, 69K in 24, dollar for dollar, just dump it into a Roth and invest it, buy stocks, whatever you want, and then just generate more tax-free wealth.
Yeah. So Adam, one of the other things we do on the planning side for some clients that are able to do it, we set up cash balance and defined benefit plans. Are any of these strategies, we spoke about IRA, we spoke about 401ks, would those apply to the cash balance defined benefit plan as well, or no?
Yeah, we have. So I actually work with a bunch. We should talk after the show. That I work with a bunch of cash balance. Basically, they're not
PPAs.
financial advisors. All they do is plan design.
Yeah.
Um, so we've done a few where we'll allow or they'll allow the cash balance plan to do alternative assets. But they hesitate. Why? Because as you know, there's defined benefits, and it's much harder to value each year in a liquid asset. And then you also have the issue of the cash flow and the valuation. So it's possible. We've seen it where some folks would take a small percentage of their combo cash balance plan and put it into alts. But the way we see it more, Stephen, is when people exit the cash balance like after 5 7 years, and they move on, they roll it into an IRA, and then they do alternative assets.
Awesome. I got it. So Adam, hopefully this people have found this really helpful, bringing this, bringing up this opportunity and items out there. So for people, that are looking to go do this, what are some of the kind of the traps for the unwary that, they are going to go out and they do want to start, doing this, what are some of the concerns they should have to make sure that this gets done correctly?
Yeah, I think that the two big ones we talked about, the prohibited transactions, right? You want to make sure you're working. There's a lot of good companies in the space. Just make sure you're asking the right question. We for example, at IRA Financial, we encourage potential clients call us, right? We have a great team of people that are available to answer your questions and make sure what you're doing is not prohibited, right? If you're like, hey, I want to buy a house and have my kids live in it, we're going to say, no, unfortunately, you can't do it. Maybe there's some workarounds. Maybe you want to do the loan, or maybe there's some other stuff. So that's number one. Number two, UBIT. Okay, a lot of people are not aware of UBIT. Even a lot of companies in the space, they're just not very well versed in it. So you want to understand that, hey, if you're going to use leverage, if you're going to use margin to buy stock, if you're going to invest in an active business through a pass-through entity, there could be UBIT. You just want to make sure you work with a company that can highlight issues and then offer you structuring techniques to minimize or maybe even eliminate any of the potential tax ramifications. So I think those are the two big ones that I always tell people, like, ask questions, talk about what your investment is, talk to your financial advisor, talk to a tax expert who understands what you're trying to do, because it's much easier, as you know, as a lawyer, a financial planner, to structure things in the beginning versus after it's done, and you're trying to unwind stuff and it gets messy.
Absolutely, absolutely. So Adam, this is interesting. I love the entrepreneur story. I love that you were an attorney and you said, "Hey, I want to go do something else." I get that, right? Very much. So as you're here working with IRA Financial, I think you said you had 26,000 accounts with the number of assets under management. What are you seeing as the next opportunity? What's out there? What's the next opportunity to innovate or for your company in this space as you look forward?
Yeah, I think I'll talk on the popular two-letter word. Like, AI is definitely going to be something that people are focused on, that we're focused on, as a way to give better customer service, right? Give people quicker, better education and customized education to what they're doing. So that's number one. Number two, what we're seeing is just people really believe more and more in diversification, right? We're seeing people that aren't just putting all their money into Bitcoin or gold or real estate, but they're working with financial planners that say, you know what, like, I'm going to take maybe 5, 10, 15, 20%, and I'm going to put it into private investments or hard money loans or real estate. So over the last 10 or 15 years, initially when I started this business, even my friends are like, are you crazy? No one's going to buy real estate in their IRA. Like, are you nuts? That's like super, super out there and aggressive. But now, for the last, really since COVID, the last 5 6 years, more and more, I think, really good financial planners are saying, you know what, it's okay to have exposure to private assets. It shouldn't be 50 or 80%, but 10 to 20% makes sense, and they're pushing their clients to do that.
Yeah. Yeah, no, that's great. That's absolutely what it is in the conversations we're having, because people, I mean, we can have a lot of conversations on, stocks and bonds, but right now it's not that fun, right? And so when we go out there and we talk about diversification, all the different assets out there, you need to have these different strategies, all in place to come together to put that together. So I think that's great advice, and that's great ideas. And yeah, there are a lot of private investment opportunities in our space. We're seeing a lot of these things that used to not be available to the common investor are now being packaged and brought down to a good price point. And so people are understanding those and putting those out there. And with those comes the positives and the limitations. It's not as easy to get in and out of those as it would be in this. So Adam, listen, this has been really great, really informative. I really appreciate your time. We'll put any of the information out there on our IRA Financial, on the podcast and things for anybody to know. In parting, is there any one, thing you'd want them to know about you, this strategy, or IRA Financial?
Yeah, I think the most important thing I always tell people, like whether you want to buy stocks or real estate, just save. Put away money, either in an IRA or 401k. It is the best, smartest way to save. You take advantage of compounded returns, generate tax deferred or tax-free wealth. That's the most important thing. You invest in whatever you like to invest in, but I always tell people just save through a retirement vehicle. I think if you're going to save, that's the smartest way to do it.
You're doing my job for me, man. I love it.
It's the truth.
That's the truth. Adam, thanks a lot, buddy.